Let's talk about credit score. I know it's not one of the most favorite things for some people to talk about, but it's extremely important. So I want you to understand how your credit score works and why it determines whether you can get the best interest rates or you can't get approved at all. Credit scores are a snapshot, a picture to a creditor of how you repay your debt. So if you make your payments on time and you don't overuse your credit, then you're a good credit risk to a mortgage company, an auto dealership, whatever you're trying to get credit. Your credit score is something that lives with you from the time you get out of high school until the time you die. You're the only one that has control of what your credit score is going to be. I can tell you the things that are important about having a good credit score, but you have to follow through on those things. That's what I want to do today. I want to help you understand the credit score system so that you can have the best credit score possible and get the best interest rates and get your loan approved. Creditors use your credit score to determine how much risk you are. What is your credit risk to them if they loan you money? It's based on your repayment history. It's based on how much debt you're carrying. It's based on how long you've had your credit established, whether you have the right mix of credit, and I'll explain that in more detail, and whether you've recently opened a lot of new credit accounts. There are three types of credit. There are mortgage loans, there are installment loans, which are like a car loan or a student loan. It has a beginning and an end. The payment always stays the same and the balance goes down every time you make a payment. The more common form of credit that we all seem to know about is revolving credit, which is a credit card. It means that you have a limit of, let's say, $1,000. You can charge $500, pay it down to $200, then charge it up to $600 if you want. It's revolving in that the balance goes up and down and your minimum payment goes up and down based on what your balance is. Those are important parts of your credit. The payment history and the length of time you have established credit make up about 50% of your credit score. 30% is based on your repayment, whether you pay it on time and make consistent payments. So those are extremely important parts about your credit score. I have a lot of people ask me when I pull their credit for a mortgage loan, why is my credit score with Credit Karma so much higher than what you're getting? And I can explain that. Credit Karma uses a credit scoring model. It's an algorithm called Vantage. It's a credit scoring model that mortgage companies don't use, auto dealerships don't use, and credit card companies don't use. It's designed to give you the highest credit score. Sometimes Credit Karma can be 50 points higher than if I pull your credit for a mortgage loan. There are different algorithms based on the type of credit you're applying for. You'll get credit scores when you are applying for a credit card that are different than if you're applying for an auto loan. And the reason for that is because with credit cards, I'm sure they're looking at your usage of revolving credit. When you're applying for an auto loan, they want to know if you pay back your monthly auto payment. And so it's weighted heavier in that area. When you're applying for a mortgage loan, we're going to look at all of it. In the mortgage industry, we all use the same credit scoring models, and they are more strict, but it's because we're loaning the most amount of money. It's important for you to understand why your credit scores are different. That explains why when you look at Credit Karma, your credit score is a lot higher than it is when I pull your credit for a mortgage loan. Credit is a huge part of the process of buying a home. Getting your debt under control and low will help you to qualify for the mortgage payment that you really want. My goal is to help you get the highest credit score so that you can get the lowest interest rate possible. It's important to me to help my clients get the best terms possible when purchasing a home because your home is the most important and largest investment you'll ever make. It's a way for you to build wealth. And if you don't understand that, please give me a call. I'd love to go over that with you and explain it. Let's talk about some credit myths that people believe. One I hear all the time is, I don't want you to pull my credit because it'll lower my credit score. That can be true if you have a lot of inquiries on your credit report. One of the things I tell my clients all the time is when you go to an auto dealership, do not give them your social security number. When they say they're going to shop and find you the best rate for your auto loan, that means it could be anywhere from 3 to 10 banks that pull your credit. That's going to hurt your credit score. The good news is when you apply for a mortgage loan, they want you to have the ability to shop for a loan. So any mortgage inquiries in the last 14 to 45 days will only count as one inquiry. So it won't hurt your credit score. Unless you have a lot of inquiries on your credit in a 180-day period of time, your credit score is not really going to be impacted by an inquiry, particularly for a mortgage loan. Another credit myth that I hear a lot is that people think that as soon as they make their monthly payment or as soon as they charge something, it's going to show up on their credit report. Creditors report to the credit bureaus once a month. For credit card companies, it's typically when they send out your monthly statement or at the end of your billing cycle. So for instance, if you have a credit card with a $300 credit limit and you charge $100 on that credit card, when you make your payment, and let's say you pay it off in full, the credit card company is not going to report that you have a zero balance. They wait until the end of the next billing cycle. If you charge on that credit card regularly, like a lot of us do, we have things that automatically go straight to a credit card. Your credit report is always going to show a monthly payment or a balance due from that creditor. It's never going to show that zero balance when you paid it off. Another thing that might be surprising to you about credit is many people think that having a zero balance is the most important thing. Actually, if you're trying to get the highest credit score, sometimes leaving a balance of $10 on that credit card will actually give you a better score than if you have a zero balance. Doesn't make a lot of sense, but I've seen it happen over and over again. Let's talk about payment history on credit cards. One of the hardest things to overcome is when you have late payments on an account. Late payments, I can't fix. I can't tell you what to do to get rid of them because typically they're legitimate. So the only thing that really fixes or helps your score come back up after you've had late payments is time. Sometimes it can be 12 months, sometimes it can be 24 months. It's just late payments are pretty devastating, so be very careful and try your hardest not to have late payments. One of the more easy things to fix, and I do this a lot with my clients, is when your balance on your credit card is too close to your credit limit. For instance, you have a $300 credit limit and your balance is $250. They actually take points away from your credit score once your balance is more than 30% of your credit limit. So if your credit card limit is $300, then anytime your balance on that credit card, when it gets reported to the credit bureau, is more than $90, it's going to negatively impact your credit score. So it's really important to know what your credit limits are on your credit cards and to make sure that you don't go over a certain amount. One thing I do want to mention, so many people think that if you have a late payment, let's say on a car loan, and then you pay off that car loan, that the late payments don't matter anymore. Unfortunately, that's not the case. Late payments stay with you on your credit report and affect your credit score for anywhere from 12 to 24 months, many times longer than that. Late payments are really important to try not to ever have late payments. One way you can do credit cards, let's say you have a credit limit of $300 and you have an emergency and you need to charge $250. What you can do is go in online and pay the balance down to below $90 before they send out your monthly statement. Because remember, the creditor reports to the credit bureau every month when they send out your monthly statement. So that should help you if you get in a bind and have to add more than 30% to a credit card. Okay, let's talk about collection accounts. So the most common collection account is a medical collection. Many people feel like they have insurance and therefore they shouldn't have to pay anything when they have some type of medical event. Unfortunately, we all have deductibles and we all have expenses that aren't covered by our insurance sometimes. There are medical bills and you do need to pay those. Many times people feel like lenders don't care about medical collections. We don't count those against you when it comes to your debt, but it does affect your credit score. It may not count against you from a lending standpoint, but it brings down your credit score. So many times medical collections are small. I will be able to tell people, let's pay this medical collection off and that'll help your credit score. Now, that leads me to the point about paying off collections. Paying off a collection and just showing it as paid on the credit report by the collection agency doesn't help your credit score immediately. It will help it in the long run because they'll stop reporting negative information. But if you have a collection account and you want to pay the balance off, contact the collection agency. Ask them if you pay the debt in full, will they delete the account from your credit report? Not show it paid, but delete it from your credit report. If they delete it, it's like it never happened, and that can make your credit score go up significantly in a very short amount of time. That's always the best policy. Many times I have people that try to get their credit in shape before they come to me, and so they've paid off collections, but they didn't know to ask the collection agency to delete the account. And so you really can't go back and ask them to do it after you've paid it. You've lost your leverage at that point. So anytime you're going to pay off a collection account, always ask them if they will delete it, if you will pay it in full. That's going to give you the best result. Okay, so here's what happens if you come to me for a mortgage loan and your credit score is low. I will be able to get recommendations for what you need to do to get your credit score up. There'll be very specific recommendations. Pay this balance down to this amount. Pay off and get this collection account deleted. Add a credit card. If you have a mortgage loan or if you have just an installment loan on your credit, like a lot of people have just student loans, and you don't have any revolving credit, just adding a credit card can increase your credit score 30 to 40 points the first time you use it. So there are a lot of things that can be done to help you get your credit score up so that you can qualify for a mortgage loan. And we're experts at that, so please reach out if you have any questions. We'd love to help you with that.